How's it going, everyone? Welcome back to another dividend investing video. 2022 was a rough year for stocks with the bear market, but with 2023 so far, things are off to a roaring start. The S&P 500 is up 6.53% year to date, and this is being recorded before the markets open the week of January 30th. With most stocks on the rise, it becomes more challenging to identify companies that are at a discount, solid dividend growth stocks on sale, but worry not. Today, I'm identifying 4 stocks in particular that I think look appealing here and are worth consideration to buy for February 2023. These are for long-term dividend growth investors and deserve a spot on your watch list. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Finding value when stocks are falling is one thing. As stocks fall, yields rise, and dividend investors like us salivate at the prospect of locking in the best companies out there at higher starting yields. With valuations rising, I wanted to use some basic criteria to select some good candidates for us. I only want to feature stocks that I would buy myself. Here's what I'm using for these stocks. There's 5 criteria. I want a dividend yield that is 10% higher than its 5-year average. I don't really care what the yield is, only relative to itself. I want to lock in a higher starting yield than average. Second, I want a PE ratio that is below or at least in line with its 5-year average. The higher quality the company is, the more inclined I am to accept buying at a fair value. One of my favorite Warren Buffett quotes is something like this: "It's better to pay a fair price for a great business than a great price for a fair business." And this is foundational to my own investing philosophies. Now, third, I want a secure dividend, ideally covered by free cash flow. Since I went through the trouble of paying for a Simply Safe dividend subscription, I'll just use their grading system, and I want a score of 60 or better. Now, fourth, I need a dividend growth track record of at least 7+ years. And finally, the stocks I'm featuring all have a 5-year average annual dividend growth rate of at least 5% or better. Those are my 5 criteria, and here are 4 stocks that stood out to me that look appealing for February 2023. Please leave a comment if you own any of these stocks and if this video has you adding anything to your own watch list. I made a point to pick stocks I've not featured all that much or at all, and stick around until the end. There are a handful of stocks I want to briefly show you that I think warrant a place on your watch list, some that I've covered but are still at an appealing valuation. So let's get to it. Company number 1, Norfolk Southern, ticker NSC. Norfolk Southern Railway is a Class 1 freight railroad that operates over 19,420 miles in 22 eastern U.S. states. They are headquartered in Atlanta, Georgia, and along with its chief competitor, CSX Transportation, these two companies form a duopoly over the freight lines in the eastern part of the United States, much like Union Pacific and Berkshire Hathaway's BNSF Railway do in the western and central United States. These companies have very wide moats due to what is a nearly insurmountable barrier to entry. I personally own Union Pacific, and if you follow our channel, you know that's one of my favorite stocks. But recently, Norfolk Southern announced a 9% dividend raise, and looking things over and taking a closer dive into it, I think this is also a very high quality company, and its valuation looks appealing right now for long-term dividend growth investors. But I do think this could be a bumpy year ahead. Now, shares of NSC are down a little over 11% over the last year, and year to date for 2023 so far, shares are down 3.59%, while the rest of the market has mostly been going up. Their recent earnings report was underwhelming. Despite record revenues, rising costs are putting pressure on margins, and guidance for 2023 has been lowered. Consider they are greatly impacted by fuel costs, which have been at all-time highs, the cost of raw materials, and the industry has also been dealing with labor issues over the last few years as inflation has put more pressure on their workforce. There are certainly some short-term headwinds, but when you have a high-quality company like NSC, the result, in my opinion, is creating an intriguing long-term opportunity. Shares of NSC are yielding 2.26%, and this is 20% above our 5-year average, which easily meets the first criteria. And I think if you can get NSC above a 2% yield, you are doing pretty good. NSC is trading at a forward price to earnings of 17.2, and this is at a discount to its 5-year average of 18.2, so that checks off our second criteria. NSC is also trading cheaper than the industrial sector as a whole at 18.3. Norfolk Southern's dividend looks well covered as it makes up 39% of forward earnings and 51% of forward free cash flow. Simply Safe Dividends assigns it a dividend safety score of 86, rated very safe, criteria 3, check. And with the latest dividend raise, we now have 7 years of dividend growth, and its 5-year average annual dividend growth rate is an impressive 15%. This checks off our last 2 criteria. The Norfolk Southern pays its quarterly cash dividend in the months of February, May, August, and November in the amount of $1.35 per share for a total annual payout of $5.40. You'll want to have your shares by February 2nd to get that next dividend later in the month. Now, shares outstanding are on the decline over the last decade, Norfolk Southern appearing to have a fairly aggressive buyback program. In 2013, there were 316 million shares outstanding, and today there are 236 million. That's a good chunk of shares taken off the market, which you love to see. The analyst average price target is about $250, representing 5% upside from current prices. And I think February and going forward for this year is going to be a good time to buy stocks like NSC. The recent dividend raise looks promising for prospects going forward, and I think this is one that will be an opportunity for a little while here, which I like for dollar cost averaging purposes. Company number 2, WEC Energy, ticker WEC. WEC Energy Group is an American company based out of Milwaukee, Wisconsin that provides electricity and natural gas to 4.4 million customers across 4 states: Wisconsin, Illinois, Minnesota, and Michigan. They're formerly known as Wisconsin Energy Group, but the name was changed to WEC Energy Group in June of 2015. They are an energy leader in the upper Midwest, traded on the New York Stock Exchange and listed on the S&P 500. This looks like one of the higher quality utility companies on the market. Take this claim for what it's worth from their investor presentation, but apparently they have beat earnings 18 consecutive years. This earnings growth is impressive, solid. This is a very solid dividend stock. Over the last year, shares of WEC are down about 2.5%, and year to date they are down about 1.5%. Shares of WEC are yielding 3.36%, which is 13% higher than its 5-year average yield. It's just under 3%, checking off our first criteria. Next, the PE ratio is trading at 20.8, and this is at a 10% discount to its 5-year average of 23.2, making this a potentially good time to pick up shares of WEC, hitting our second criteria. The dividend takes up 70% of forward earnings. For many industries, this would seem high, but for utilities, it's actually on the lower side. Simply Safe Dividends gives us a safety score of 87, very safe, and criteria 3, check. And for our final 2 criteria, we have 18 years of consecutive dividend raises with a 5-year average annual growth rate of 6% per year, checking off our final 2 criteria. These stats are solid for a stock in the utility sector. WEC Energy pays a qualified dividend quarterly in the months of March, June, September, and December in the amount of 78 cents per share for a total annual payout of $3.12. The average analyst price target is $101.42, representing 9.32% upside from current prices. So if you're looking to beef up your exposure to the utility sector, I think a lot of dividend investors often overlook this sector. You could do a lot worse than WEC Energy, and shares look undervalued at this time. So I've been asked for ways to support the work we are doing on this channel, so I've created a couple ways you can do so. I am a single father who does this in my spare time, and I work full time. The first, I made an account at buymeacoffee.com where you can buy me a coffee as a way to support the channel, and you can find a link in the description. Personally, I'd rather use your money to buy dividend stocks, but if you want to support my work in this way, it is much appreciated. And second, much of the data here I get researching from the website Seeking Alpha, and I've partnered with them to bring you a wonderful offer for 50% off your first year of their premium membership. This comes out to about $12 a month, and I think it is a great value for all the information you're getting on Seeking Alpha, as well as all the excellent articles. This site is instrumental in my research to produce the content I do for you guys, and you can use the link in the description to get 50% off, and this is a great way to help support the channel. And finally, you can help me out tremendously for free by simply liking this video and making sure you are subscribed. Thanks again. Company number 3, Broadridge Financial Solutions, ticker BR. Broadridge Financial is a public corporate services and financial tech company spun off from Automatic Data Processing back in 2007. Today, they supply publicly traded companies with proxy statements, annual reports, and other shareholder communication services. They heavily dominate the proxy voting and shareholder communication services industry. Their motto is, "We're in the business of helping you do business." So they are vital to the stock market. This is a company most of us deal with on some level as investors in the stock market. Many investors have never heard of them. But they are on the S&P 500 with an $18.6 billion market cap and feature a strong dividend growth track record in their short time as a company. Over the last year, shares of BR are mostly flat, only down about 0.5%. Today they sit closer to their 52-week low than their 52-week high. Let's see if it fits our criteria. Shares of BR are yielding just under 2% and are 17% above the 5-year norm of 1.66%, so criteria 1, check. Looking at valuation, Broadridge is trading at a PE of 21.2, and this is a 14% discount to its 5-year average of 24.7, meeting our second criteria. The dividend makes up 41% of forward earnings, and we like to see this below 60%. The Simply Safe Dividend safety score is 75, rated safe, criteria 3, check. Moving on to dividend growth, the dividend has gone up every year since 2007, when the spinoff of 15 years of dividend growth. If you combine it with automatic data processing history, they easily hit dividend aristocrat status, criteria 4, check. And with 14% average annual dividend growth rate over the last 5 years, that easily meets our final criteria. We love to see that. The qualified quarterly dividend payment is made in the months of January, April, July, and October in the amount of 72.5 cents for a total annual payout of $2.90 per share. We should get that 16th dividend raise this fall. Looking at shares outstanding, shares are on a very gradual decline, nothing major, but definitely glad to see this number isn't going up and shareholders are not being diluted by Broadridge. The average analyst price target is $164.94, representing over 10% upside from current levels. This is a necessary business that public companies rely on with a strong competitive moat. They have an excellent track record of double-digit dividend growth and a history of outperforming the market. I think shares of Broadridge Financial look appealing as they are a high-quality company, meeting all our criteria, and at the very least belong on your watch list. Company number 4, Lowe's Companies Inc., ticker LOW. Lowe's is a retail company specializing in home improvement, operating in the United States and Canada with close to 2,200 home improvement and hardware stores. They were founded in 1921 by Lucius Smith Lowe. Their first store was named North Wilkesboro Hardware in North Carolina. 101 years later, Lowe's is the second largest hardware chain in the world behind rival Home Depot. Lowe's has the distinction on this list of being a dividend king with more than 61 years of increasing its dividend payment, making it an ideal company for long-term dividend growth investors. The stock really dropped in 2022, and after looking things over, I think the stock is still a buy in 2023, and I'll show you how it meets our criteria. Lowe's is down over 10% in the last year and well below the 52-week high of $240. Shares of Lowe's are trading at a 2.07% yield, and this is 14% higher than its 5-year average, making this a decent time to lock in a higher than average yield on cost for this dividend king. Criteria 1, check. Lowe's is trading at a 14.5 PE, and this is an 18% discount to its 5-year average PE of 17.8, looking attractively valued and meeting our second criteria. Lowe's dividend is well covered by 30% of forward earnings and 32% of forward free cash flow. Like to see those close to each other like that, and it's leaving plenty of room for future dividend growth. Simply Safe Dividends provides us a dividend safety score of 93, a very safe dividend. Lowe's features one of the most impressive dividend growth track records out of all the dividend kings. We have 61 years of dividend growth meeting criteria 4, an 18% average annual dividend growth rate over the last 5 years, crushing the 5th criteria. The dividend is paid out quarterly in the months of February, May, August, and November in the amount of $1.05 per share for a total annual payout of $4.20. Lowe's does so many things right from the perspective of a shareholder, aggressively buying back shares year over year, going from 1.15 billion shares outstanding in 2013, while today there are only 650 million shares out, significantly cutting down the amount of shares. And look at this return on invested capital, consistently high, but these last 2 years it's ridiculous at 48% ROIC in the last 12 months. The average analyst price target is $236.05, representing over 16% upside from current prices. If it sounds like I love the stock, I do. I've been a shareholder for a while, and while shares aren't quite as low as they were last summer, Lowe still fits all of those criteria quite easily. I will certainly be adding to my position as long as it's at these levels. Alright, and as promised, I'm going to throw a few bonus picks out there that I think are looking like they're at a discount, at least relative to themselves, and are appealing right now for dividend growth investors. First, look out for Pepsi. It's not cheap, but notice it's now in the 160s again for the first time since October. Its price is about flat for the last year, and you can see in this graph each of these dips were great times to add to a position in Pepsi. And with the stock down more than 5% in 2023, I think we may be heading into another one of those dips. This is not a stock that really goes on sale per se, but it does give you opportunities if you are long term. I will personally never sell my shares of Pepsi, and I plan to add to this in February, assuming it stays in the 160 range. Next, let's look at T. Rowe Price. T. Rowe, we featured this one before. Right now, its dividend is sitting 54% higher than its 5-year average, above 4%. This stock is down over 22% in the last year, but this is a high-quality company. They are in the asset management business. They carry no debt. They buy back shares. They have a 5-year average annual dividend growth rate of 15%, coupled with 35 years of consecutive dividend raises. Some folks are writing them off as obsolete, but if you have a 401k plan, you will probably find some of their funds available there. I have a small position that I'll be adding to slowly anytime it's above that 4% starting yield. Also, I still think Kroger, ticker KR, is at a good valuation. I put out a video showing you my fair value for this one about a month back, and I have a link in the description if you want to check that out. It still applies, but I mean, look, it's a forward PE under 11, double-digit dividend growth, 15 consecutive years of dividend hikes, strong buybacks, strong return on invested capital. They're an industry that I would want to own during tough economic times, so keep Kroger on your watch list. Finally, Medtronic. I've been talking about this one for a couple months now. I also featured a valuation video on that. It continues to remain significantly undervalued. I considered featuring it again, but I can just point out the valuation videos I did there. It's also in the top healthcare stocks to own in 2023, another video I did. We have a dividend raise streak of 44 years. They're growing their dividend at 8% per year. Currently, shares of Medtronic are yielding 3.29%, and up until recently, we've never been able to lock in that sort of starting yield for this high-quality medical device maker. You know what, I also think the usual suspects that have been beat down, like the Altria, Verizon, Walgreens, they continue to look interesting if you're looking for higher yield. I think all three of these companies are primed for recovery over the next few years, and I own all three myself. And that's all for today, folks. If you are still here, thank you so much for sticking around. Please follow me on Twitter. Make sure you follow me there. It's at DivGrowthIncome. I love connecting with you guys. Also, of course, make sure you are subscribed. And we'll see you next time. Have a great day. Keep investing.